Logical. So if you've looked at the financial headlines this week, you might feel like you're standing at, a crossroads. It feels like total AI euphoria meeting deep systemic panic.
Yeah, it's a strange mix, isn't it? How else do you square a cooling stock market with, this massive political gridlock?
Exactly. And then, so if you've looked at the financial headlines this week, you might feel like you're standing at, so if you've looked at the financial headlines this week, you might feel like you're standing at, a crossroads. It feels like total AI euphoria meeting deep systemic panic.
Yeah, it's a strange mix, isn't it? How else do you square a cooling stock market with, this massive political gridlock?
Exactly. And then the biggest shocker, gold. The oldest safe haven just blasting past a number, a psychological barrier that honestly few people thought we'd see this year.
Right past $4,000.
Yeah.
Incredible.
Our mission today really is to give you a map for navigating this intense volatility. We're doing a deep dive into a whole stack of sources.
Yeah, we're pulling together info on everything from those high-flying tech stocks maybe hitting a wall.
Buyer exhaustion, they're calling it.
Right. To the real-world impact of the US government shutdown and what it actually means when gold surges like that.
It is fundamentally a contradictory picture.
Absolutely. The sources really back that up. You see this collision. On one hand, data showing investors are tired after that amazing run, a big risk-off signal.
But at the same time,
Geopolitical instability that's basically screaming at investors to pile into commodities. So we're going to break down the technicals behind the S&P 500 dip
and really analyze that gold surge. What's driving it? What are the implications?
and look at moves like Tesla's price cuts, which kind of reveal the deep competitive pressures bubbling under everything.
Okay, let's start with the stock market pause. So the S&P 500, it pulled back recently to around, what, 67.15?
Approximately, yeah. Which might sound small, like a minor correction.
But you have to remember the context. This came after a huge climb, like $16 trillion added since the April lows.
Driven almost entirely by AI excitement.
Exactly, AI exuberance. And now Wall Street's using this phrase, buyer exhaustion, basically saying that string of all-time highs, it just ran out of steam.
And what's fascinating looking at the sources is how selective this exhaustion was, especially in tech. Remember, that whole $16 trillion surge was built on the promise of AI. But now, investors are getting picky, hyper-selective. Take Oracle. It fell 2.5% right after a report showed its cloud margins were, well, lower than expected.
So if you're not delivering those fat margins on AI infrastructure.
The market punishes you. Simple as that.
Okay, and Tesla.
Tesla also dropped over 4%. And that was despite launching new, cheaper models. We'll dig into that strategy in a bit.
But it wasn't all bad news in tech.
No, not at all. Right next door, you had Dell. Dell actually rose 3.5%. Why? They raised their forecasts, and they specifically pointed to strong AI demand.
So the market isn't ditching AI altogether.
Not at all. It's just getting much smarter, much more discerning about who's actually making money from the trend versus, who's just selling the hype.
And that winning streak before the pause, we saw that 9-day run in the S&P ending mid-May. Historically speaking, how rare is that? Should we have seen a pause coming?
Oh, absolutely. That 9-day streak?
Yeah.
Exceptionally rare. It's only happened like 14 times in history.
Wow.
The longest ever was 14 days straight, way back in 1971. So, yeah, it reminds us of a core idea in investing, mean reversion.
Mean reversion,
Yeah.
like things snap back to average.
Exactly. Think of the market like a rubber band. That crazy 9-day run stretched the rubber band way out, far from its average, the mean. And once it's stretched that far, statistically, it's much more likely to snap back, to revert towards that long-term average. It's basically physics, but applied to finance.
Makes sense. The rubber band stretched too far, and now we see the snapback. Okay, let's pivot. Let's talk about the ultimate safe haven, because this is where that market exhaustion seems to meet, well, almost existential fear. Gold. Prices surged to completely new record, trading above $4,000 an ounce for the first time this week. Futures hit $4,014. Spot price was right behind it.
And the year-to-date game is stunning. We're talking about 50, maybe 51%.
So this historic breach of $4,000, it's got to be more than just momentum, right?
Yeah.
Although the ETFs, the gold ETFs, they pulled in a record amount last month.
Yeah, $17.3 billion. That's huge.
Sure.
But you're right, the core drivers go much deeper. They're profoundly systemic.
Okay, break that down. What are those systemic drivers?
Well, initially, you definitely had political instability feeding into it. That first push towards, say, $3,895 an ounce. That got triggered by the US government shutdown,
Right.
and then compounded by political issues in France, rising Japanese bond yields,
Yeah.
things like that.
But the bigger picture.
The bigger, longer-term idea analysts are really pointing to now is what they call the debasement trade.
Debasement trade. Okay, that sounds incredibly serious. What does that actually mean for the average person listening? Is it just a fancy way of saying, I'm worried about inflation?
It's more specific than just general inflation fear.
Hmm.
The debasement trade means investors, especially big institutions, foreign players, they're hedging against a serious loss of faith.
Faith in what?
Faith in the integrity of the U.S. dollar. And crucially, U.S. Treasuries. They look at the ballooning federal debt, which is just staggering right now.
Mhm.
And they think the U.S. government will have to resort to massive spending, massive money printing, which effectively devalues or debases the dollar.
So gold becomes the insurance policy.
The ultimate insurance policy against the Fed having to print tons of money to handle the debt. Hitting $4,000 is a loud, clear signal that global investors are taking this debasement risk very, very seriously in their long-term plans.
Okay, if that's the underlying signal, what are the forecasts saying now? Because some of these predictions are starting to sound pretty extreme.
They are getting quite bullish. UBS thinks we'll see $4,200 an ounce by the end of 2025.
Okay.
Goldman Sachs, even more bullish. They raised their forecast to $4,900 by the end of 2026. They talk about sticky inflows from Western ETFs and central banks.
But then you get warnings, too.
Well.
Economist Peter Schiff, he warned this gold rally signals an impending bust in stocks. Much worse, he said, than the dot-com bubble bursting.
That sounds intense. Is there anything really backing up that level of fear, or is that just typical doom and gloom? Well, Schiff is definitely known for his bearish calls, no doubt. But the argument for why this could be more severe, based on the source material, lies in the dollar's role historically.
How so?
Think about past bubbles, the tech bubble, the housing crisis. During those times, there was still underlying faith of the U.S. economy and the dollar itself.
Right, the foundation seems solid, even if parts of the market were shaky.
Exactly. What makes this potentially different, according to Schiff's argument, is that the systemic risk isn't just about company valuations anymore. It's about the global financial architecture itself.
So if gold is telling us faith in the dollar is eroding,
then all dollar-denominated assets, including stocks, face a headwind they've never really faced before. That's why that $4,000 barrier feels so significant. It's a crack in the foundation.
which brings us right back to the political gridlock in the U.S., which seems to be driving a lot of this loss of faith. The government shutdown started October 1st, 2025, and the effects are really spreading now.
Yeah, the initial reaction was textbook risk off. Treasuries rallied, the dollar weakened a bit at first.
But the deeper problem,
The deeper, more dangerous issue is the systemic data blackout. The shutdown delays critical economic reports from places like the Bureau of Labor Statistics, the Census Bureau.
okay, explain why that blackout is such a big deal. For someone who isn't an economist, why does missing a few reports matter so much?
It matters because it effectively blinds the Federal Reserve. The Fed relies on those real-time numbers, employment figures, retail sales, inflation data, to know what's actually happening in the economy.
So they can set interest rates correctly.
Precisely. Without that data, they're flying blind. They can't tell if the economy is just cooling off gently or if we're, sliding into a serious downturn.
Which just adds more uncertainty.
Massively complicates their decisions, adds another layer of risk, and reinforces that move into things not tied to government promises, like gold.
And there's a real economic cost, too, right?
Oh, absolutely. You're talking about an estimated $400 million a day in lost wages. That hits maybe 750,000 to 900,000 federal workers. That immediately puts a damper on consumer spending.
And affects companies.
For sure. Companies tied to government contracts, think defense giants, Lockheed Martin, Boeing, they feel the pressure immediately. While defensive sectors, consumer staples, and gold miners tend to hold up better.
And while the economy's flying blind, the Fed itself seems completely split on what to do next.
Deep internal conflicts, yeah. You had Fed Governor Mirren suggesting, well, the impact of tariffs on inflation isn't that bad, so maybe the Fed can keep ease in policy. Still sounds pretty dovish.
Well, then
You have Fed President Kashkari warning that cutting rates too much risks, sending prices spiraling again. Much more hawkish.
So conflict at home, and then you look globally and you see major policy differences emerging too, especially in Asia.
Japan is a perfect example, kind of a counter story to the U.S. risk-off situation. The Japanese yen weakened quite sharply after Sanai Takaichi was elected leader of the LDP.
That's the ruling party, right?
Right, the Liberal Democratic Party. And Takaichi, she favors traditionally loose monetary policy, big government spending.
Why is that so significant now?
Because it's expected to make the Bank of Japan's job much harder. They've been trying to gently raise rates, normalize policy after decades of near-zero rates.
But if the political leadership is pushing for stimulus,
The market bets the Bank of Japan will be forced to keep policy easy. So that political shift reinforces global easing pressures, keeps the yen weak. This divergence the U.S. debating tightening, while Japan looks set for more easing, creates really choppy, volatile currency markets.
which is a huge factor for international investing right now.
Absolutely, you get these cross currents. U.S. instability drives safe haven buying into gold. Japanese politics reinforces easing, pushes money out of the yen. It's a tangled knot.
Okay, let's untangle one more piece and circle back to the corporate world. The final bit of news that seemed to weigh on the S&P 500, Tesla.
Right. Tesla launched cheaper versions of the Model Y and Model 3, priced just under that key $40,000 psychological mark.
Specifically,
$39,990 for the Model Y, $36,990 for the Model 3.
and this is a strategic gamble, right?
Yeah.
Moving down market.
Textbook gamble. Shifting from that premium, high-margin approach to focus more on volume, the argument for it is pretty clear.
Which is?
They lost that big $7,500 EV tax credit back in September. So to keep market share, to boost overall sales numbers, they almost had to cut prices. And $39,990 for a Model Y, that's seen as a really attractive price point for a lot of buyers.
But the critique was immediate and pretty harsh.
Very harsh. Analysts called it a double-edged scalpel, meaning yes, you cut prices, you potentially gain volume. That's one edge.
But the other edge.
You risk seriously squeezing your profit per car. And you might even cannibalize sales of your higher margin, more expensive versions. People might just buy the cheaper one instead.
And there was that colorful description, Tesla slipping into a Walmart hoodie.
Yeah, that quote captures the brand concern perfectly.
Why that specific phrase, Walmart hoodie?
Because it hits right at brand perception. Tesla built this image, this halo, as the cutting-edge luxury tech leader.
Right, the aspirational brand.
Exactly. By chasing the sub-$40,000 market so aggressively, they risk watering down that premium identity. Basically, shifting from being seen as a tech innovator to more of a mainstream price-driven car company. It makes you wonder where they see future growth coming from.
And it feeds into that innovation plateau criticism.
Precisely. Critics are saying, look, instead of delivering the robotaxi or the next-gen roadster, these big, ambitious projects,
They're just cutting prices on existing models.
right, using price elasticity to grab short-term sales. Several sources suggested that to really fight off the low-cost Chinese EV makers, Tesla needs a car under $30,000, not just under $40,000. This move feels more like plugging a hole than a fundamental leap forward.
Okay, so let's try and synthesize all this. We've seen a market really wrestling with these conflicting forces, but they're all connected.
Definitely interconnected. First, you had that AI enthusiasm hitting the reality of earnings, forcing that necessary mean reversion, that pause in the market.
And second,
Gold's historic surge, reflecting deep systemic worries about the dollar's future, fueled by political gridlock and all that debt.
and third,
Corporate giants like Tesla, aggressively cutting prices, sacrificing margin just to keep market share, which really highlights how tough the competitive environment is in what feels like, frankly, a slowing consumer economy.
So the essential takeaways for you listening to this, they really center on those bigger systemic risks. Remember the importance of that data blackout from the shutdown. It ties the Fed's hands, adds huge risk to policy decisions.
And don't just brush off that $4,000 gold price as noise. It signals way more than just momentum. It's showing a global lack of faith in traditional financial anchors and this growing acceptance of the debasement trade.
Which leads us perfectly into our final provocative thought.
Right. The World Gold Council did an analysis suggesting that during a big stock market sell-off, the one factor that really seems to matter most is the direction of the U.S. dollar. So, considering that this debasement trade idea is now firmly part of the conversation, think about this. How much will the recurring political messiness, the shutdowns, the debt ceiling fights, how much will that ongoing erosion of confidence in the dollar become the main long-term risk you need to worry about?
More important than traditional stuff like PE ratios or company earnings.
Eventually, yeah. It forces you as an investor to look really hard at Washington, D.C. and what global central banks are doing, maybe even before you look at the balance sheet of the company you're thinking about investing in. It changes the whole game.